Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day. In this video, I am going to walk you through the process of valuing GameStop stock by analyzing their financial ratios and dissecting their financial statements so we can determine if it's a buy or a sell. GameStop is a video game and consumer electronics retailer. The company's headquarters are near Dallas, Texas. It operates 5,500 retail stores throughout the US, Canada, Australia, New Zealand, and Europe. In addition to retail stores, GameStop also owns Game Informer, a video game magazine. Let's get started with the model. This is a large cap company, 24 billion market cap. They're trading at $3.60 a share, and they have 70 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So the company does have positive free cash flow each year except in 2020. Net income is the profit and loss on the income statement. It's revenue minus expenses. And they have a small positive in 2018 and negative in the other years. Revenue is not doing so well. It goes from 9.2 billion to 6.5 billion, but then jumps a bit in the trailing 12 months to 7.3 billion. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue, and the difference between those two numbers is their gross profit. That was the highest in 2018 at 3 billion. It's down to 2 billion now. Below that is operating expenses, and then below that is operating income. So you can see the company hasn't generated much operating income since 2019. Then below that is the interest they pay on their debt, that's 31 million. Then other income and expenses. So it looks like the company's passing through lots of asset impairments. An asset impairment is when you decrease the value of an asset on your balance sheet and then pass through the expense onto your income statement. So it brings down your net income, but it does not affect cash flow. So this company has negative net income almost every year because of these large asset impairments. They did have a small positive 35 million in 2018. This is the company's statement of cash flows. The top line is operating cash flow. So the company lost money on its operational business in the trailing 12 months and in 2020. Then you have capital expenditures, which are investments in property, plant, and equipment. Operating cash flow minus CapEx gives you your free cash flow. There must be some information missing because negative 150 million minus 89 million doesn't equal positive 149 million. The high-level information tends to be correct in Yahoo Finance. So it looks like the company was doing a good job paying down debt. They paid down 400 million in 2020. And they pretty much paid down what they issued in 2018 and 19. The most important part of any business is their operating cash flow. If you cannot generate positive operating cash flow, then you don't have much of a business because you cannot rely on debt and equity financing to run your business in the long term. This company had negative 150 million in the trailing 12 months. The way you calculate that, you start with net income. That was negative 680 million. Then you have to add back the asset impairment, because that was an expense on the income statement, but it's a non-cash item. There was a non-cash gain of 97 million, so we have to minus that out on the CFO section. Then there was 31 million of deferred taxes and 87 million of depreciation. So this company seems to be struggling because they did have positive operating cash flow, now they have negative. Let's look at a capital structure. $600 million of equity, 1.2 billion of debt. They're 34% equity, 66% debt. Their net debt is 689 million. That means they could pay off about 500 million of debt with the cash on their balance sheet if they wanted to. Their WACC is 12.8%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4, that's 4 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $3.5 billion. We divide that by 70 million shares. And we get a calculated stock price of $49. They're trading at $360, so they're trading at a significant premium. It's a sell according to the model. The stock was really low for a number of years, but it shot up the last 2 weeks. It's already up over 100% today, and it went up 100% yesterday. Reddit is really pumping up this stock. That's the only reason the stock price is so high, not because the company is generating lots of money. It seems like the people on Reddit don't want the short sellers making any money. This is a traditional pump and dump, and I can't believe how high it's gotten. I would have sold already. I would have probably been upset because I would have probably sold yesterday. It went up over 100% today. It's like people are willing to give $360 for a $50 bill. That strategy can't last forever because you'll run out of money at some point. The people holding the bags at the end are going to get crushed. The company used to pay a dividend, but they suspended it in 2019. So 119 million shares are traded each day on average the past 10 days, which is a ridiculously high number. Of the 70 million shares outstanding, 47 million are on float. 122% are held by institutions. Obviously, it can't be over 100%. It's just a timing issue with Yahoo's calculation. The short percentage is 260%. The people who are going to make the most money are the people who bought the stock early on and got out before the drop, and the short sellers who shorted the stock at the peak or close to the peak. But that's just going to be a small percentage of people. The other 95% of people will lose money. The company's beta is close to 1.5, so the stock moves 1.5 times the market. The stock has gone up 3,500% in the past 52 weeks. The low was 257, the high was 380. And the stock is obviously trading well above its 50-day and 200-day moving average. If you invested $10,000 into this company 10 years ago, you would have over $100,000 today. FMR owns almost 14%, then RC Ventures, BlackRock, Vanguard, and then the last company owns 6.3%. Let's look at the financial ratios. The average PE in the market's 11.6, the median is 14.5. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. Negative net income, negative PE. Price to sales is stock price over sales per share. They're at 3.4. It is surprising they have a good price to sales ratio. That means investors are paying $3.40 for $1 revenue. Price to book is stock price over book value per share. They're at 41.2, much worse than the median and average. And the way you calculate book value per share, it's equity over shares outstanding. Equity is assets minus liabilities in the balance sheet. And they have $612 million of equity, $589 million of tangible equity. They have $23 million of other intangible assets on their balance sheet. Interest coverage ratio is EBIT over interest expense. They can cover their interest payments more than 2 times. ROE is net income over equity, negative net income, negative ROE. Current ratio is current assets over current liabilities. They're at 1.3. That's a good current ratio. And they have $500 million of cash, $141 million of receivables, and $860 million of inventory. So it does seem like the company does have enough capital to get through the next 12 months without taking on any more debt. They had $150 million of free cash flow and almost $400 million of working capital. The best way to look at ratios is to compare them to similar companies. I've done videos on Big 5, Canadian Tire, Office Depot, RH, Ulta Beauty, and Williams-Sonoma, all in the same industry as GameStop. And if GameStop has a number in red, they're worse than the average. If they have a number in green, they're better than the average. So they're worse in every category except market cap. Yesterday, they didn't have the biggest market cap, but today they have the biggest market cap at $24 billion. So to summarize, I do have them trading at a significant premium. I rank their free cash flow 5 out of 10. It did peak in 2018. They had a big negative in 2020. They did squeak out a small positive in the trailing 12 months. I give their revenue 7 out of 10 because it has improved in the trailing 12 months. Probably lots of people sitting at home, they need something to do, so they're playing video games. And I give their ratios 2 out of 10. They have really weak ratios. Some of their ratios look so bad because their stock price is inflated. I don't think I have ever seen a stock perform like this, mainly from social media pumping it up. But I'm really curious to see how the stock plays out over the next few weeks. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.